Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. First of all, I hope everybody had a wonderful holiday weekend, got a chance to spend it with family, friends, and loved ones. I got an opportunity to play some golf over the weekend. It was also my birthday weekend. Still got my golf hat on, as you can see. It was pretty hot. Maybe you can still see the sweat marks on there, but I wanted to show you this. I also got a chance to go see the new Spider-Man movie, hence my Spider-Man ball mark that they had in honor of the release of the movie, which is a great movie, by the way. I mean, I'm one of those guys that as a kid was actually reading the Spider-Man comic books. I go back to the very beginning of Spider-Man. He's the you-know-what to me. In fact, every year at Halloween, I dressed as Spider-Man. But anyway, last time we chatted, we were getting ready to go into the G20 meeting. Market was floundering just a little bit going into the meeting, and we had, I got a feeling that something positive was going to come out of that, and the market was actually going to move to the upside, which turned out to be true. So call that a spidey sense, if you will. Anyway, let's take a look at the charts now and see where we go from here. Looking at a current chart of the S&P500, you can see that here we were on the 26th of June. That was the last recording when we did the Got a Feeling, and from there we moved to the upside, broke to new highs. You can see the 5 relabeled, and we've moved up from there. So the question becomes, now what happens? Now where do we go from here? This move to the upside worked out really well, gave us an opportunity to get some upside breakouts of the bullish case studies that we have for our subscribers. Now you might look and say, is this a zigzag right here? So let's take a look at that before we look at anything else. So we'll use the fib retracement tool and go there, and you can see that that was a 23.6% retracement. Let me put that back on there again. I don't have it fully highlighted. I just have it shaded, and I do that on purpose because that doesn't count as a retracement level for me. There you can see the grayish line there right at the 23.6% fib retracement level. So even though that's a fib level and it acted as support, so the market bounced off of that level, it doesn't count as a full-blown corrective level. To me, it has to go at least 38.2%. So for me, this all is one impulse move. It's all the wave 5 impulse. So we could still get a complex wave 5 if we were to pull back. It looks like we may be coming back to test the breakout. We'll see how things play out. We did have a little bit of a move down on Friday, but you can't count that because nobody was there. Everybody took a long weekend off. But you can see that we did come down and fill this gap there. That one's filled, but we still have one here that hasn't gotten filled. And if you go back and look recently, we had a gap there. That eventually got filled. Gap here, gap there, those got filled. Little gap there, that got filled. So the only gap in the chart right now that hasn't been filled is that one. Now we know it will get filled. It's just a matter of when. So we could continue to the upside and complete the wave 5 before that gap gets filled, and it gets filled on the corrective level that always follows the completion of a wave 5, or we could come back, test the breakout above the 3, close that gap, and then go up to the new wave 5 high. So we're in a little bit of a flux now, but we're in a pretty confirmed wave 5 move here. And if we put the moving averages on, you can see that we came down and tapped the 10-day moving average, but we're still above the 10-day moving average. We still closed above it. So all signs from that indicator is that we are still in the momentum phase to the upside. Taking a look at the DMI. DMI still looks pretty good. We still have good separation from the 2 directional indicators, and the ADX is moving up, so it's confirming that there is strength to the move, so it's not a weak move. So we'll see if it continues. But there's no indication that we would do anything other than maybe test the top of that wave 3 if we get a pullback. Wanted to look at some things that we hadn't looked at for a while. A lot of people have been talking about, in fact, a lot of people felt that there was not going to be anything positive come out of the G20. A lot of pundits were looking for a pretty significant downturn because of the no deal or the China playing hardball or whatever. And then we came out with the truce, and that was enough to move the market to the upside. But a lot of people don't feel like a market can move to the upside if it doesn't have the semis or the small caps or both. So let's look at those. Here's the Russell 2000. is a chart which is the small cap stocks, obviously. And then we have a wave 5 pattern here with a wave 4 corrected 54%. We look at this, and this is a mono wave 4, corrective wave 4, right in a 45-degree angle. And look, let's take a look at this little move down. That looks like that would have made it to at least the 38.2% corrective level. And it did. Look, it made it all the way to the 50% level. So we have a complex wave 5 underway. Hasn't been labeled as a 5 yet, but it will once we break that 3 top. But that's why we can follow along with these zigzag patterns. And it's another reason why they're so important, so that we can get an idea of what's going to happen sooner. So if with a 50% B wave correction, we would be looking for a 100% extension, which would take the Russell up to around 1629 or so. Notice that we went up, hit the 61.8% fib extension level, and bounced back down to the 38.2. That is all classic action there, where you go up to one fib level, run into resistance, come back and test the previous before moving to the next level. So at least at this point, there's nothing showing in the Russell that would lead us to believe that we couldn't move higher from here either. So we can go ahead and label that as the A wave in the zigzag. Move that to where you can actually see it. And the B corrective level. And then the C wave that is currently underway. And then you know where the target price is. So the Russell looks pretty good as well. Let's take a look at the SMH. So this is the semiconductors. Same type of thing. In fact, look at that wave 4 with a 61% corrective level. My favorite corrective level, right at that 61.8% fib level. I couldn't be much better. Also with a mono wave 4 corrective level. And we also have a looks like a zigzag pattern here. Now this one looks a little different. This one looks like it's either completed or maybe moving into an extension. So let's see what we have here. Taking a look at that. This stuff is just unbelievable. The LA wave right to the 61.8%. I actually, believe it or not, haven't analyzed these charts before now. They're not normally charts that I follow a lot. I just thought I would show you something different because this is the stuff that's talked about on TV all the time. So 61.8% fib corrective level. So that's also a zigzag pattern with a confirmed A and B correction. Now let's see the extension, because we may be close, if not at the 100% level. We are. Look at that. We opened above it and closed back below it. So right up to the 100% extension. So that zigzag's complete. It's done everything it's supposed to do. Spot on. Couldn't be any more pure Elliott wave Fibonacci support resistance levels. If you tried, you couldn't telegraph it any better or script it any better. 61% wave 4 correction. Perfect zigzag pattern in the wave 5. Now the question becomes, what happens from here? Well, if we're going to have an extended wave 5, an extended C wave in this zigzag pattern, we would go up to the 161.8% level. But after hitting the 100% level, the rules state that, again, you come back and test the previous fib level. Same thing we just talked about with the chart of the Russell. You come back, test the previous fib level before going to the next, and that's exactly what's happened. And look, we've gone sideways. We've come down right at the 61.8% level, so we hit the 100%. Couldn't close above it, didn't even close above it, opened above it, but couldn't close above it, came down, filled that gap, and found some support here at the 61.8% level. It's done everything it's needed to do if it wants to have an extended C wave and move on up to the 161.8% level. And that's not where the wave 5 is yet. We're just talking about the zigzag within the wave 5 here. There's an impulse zigzag. So let's take all this stuff off and go ahead and label that one as well. So when you're hearing people say that the market can't move without the small caps, it can't move without the semis, and then it was actually on the financial networks today that whoever the person was, and we don't need to get into talking about names of what other people say, but they said they didn't feel like they looked that good. Well, to me, they look okay. The thing here is that this is a completed, and we want to make sure that we emphasize that that's a completed zigzag. That's done. It's done everything it needs to do, but it could move into an extended C wave. That happens. Just because it went to 100% doesn't mean that's necessarily the end of the move. It means that that rule was satisfied. We had a 61.8% correction in the B wave. We're supposed to extend 100%. It did. But it can go 161.8 and what's known as an extended C wave. That's the possibility. That's what we were just showing. So we'll see how that plays out. And I also wanted to show you the VIX, because last time we talked about this, we had this triangle here, and there was speculation that with the triangle, the likely break move was to the upside. And we talked about the fact that if you go back and look historically with how low the VIX has gone to the 12 level back last year, and then the year prior, the beginning of 2018 and in 2017, we were all the way down to 9. So there was room for a downside break in the VIX from that triangle, and that's exactly what we got. And right now we came down and found support at that 12 level. But as you just saw, we could break that and go down as far as 9 if the market wanted to. So we started to break out of the triangle, came back, tested the breakout, so broke down, came back, tested it, got down and ran down on the VIX down to that 12 level. So just because we're down at 12 doesn't mean we can't go lower. We said the same thing when we had the triangle at 16, that there was enough room for downside breakout. And that's what happened. So everything has fallen into place. So as we look at the charts now, there's nothing showing that we couldn't go higher from here. The only thing that we would want to keep an eye on is this gap that may need to get filled first. So the market may want to come down and fill that gap, and we would be right at that wave 3 high. That should act as support for a continued move back to the upside. But we'll also keep an eye on the SMH, on the semiconductors, to see if, because this wave C completed, we may not have an extended wave C. If we don't, then the target price is here. Since it's completed, we need to talk about the opposite side of what can happen. Since the wave C completed, it could move down and should retrace that entire impulse C. So your target price to the downside, if we don't hold, it should hold where it is now, right around that 110 level, if it's going to go higher. If it's going to have a C wave extension, it should hold right in here. If it breaks that level, we're likely coming all the way down here to just above 100. So that gets you caught up. Again, hope you enjoyed your holiday weekend, and we'll be back to talk to you again next week. Take care, everybody.